All right, let's dive into Redwire Corporation's pivotal 2025 fiscal year. We're going to start with the big, exciting picture of the new space economy, but then we're going deep, really deep, into the company's 10K filing to unpack what was a massive, game-changing year for them.
So there is a brand new boom happening in space right now. We're talking about everything from building things on the moon to launching next-gen satellites and even manufacturing in orbit. And in this new gold rush, Redwire is positioning itself as one of the key picks and shovels companies. You know, the ones providing the essential gear to make it all happen.
And we're not just talking about ideas on a whiteboard. They are making the literal building blocks for some of humanity's most ambitious missions. Think about their patented solar arrays powering the International Space Station, or the docking systems for future commercial space hubs, and even the tech needed to, actually build stuff on the moon.
But 2025 for Redwire wasn't just about cool space tech. No, it was the year the company completely re-engineered itself. It was a huge, strategic pivot.
Here's the core of it. The company went out and basically bought its way into the defense industry. Now, this move absolutely supercharged their top-line growth, but as we're about to see, it also made for a really complex financial story that you have to look at closely.
And this really shows you the before and after. Redwire started as this very focused, specialized supplier for civil space missions. Long projects, very custom. Now, they're an integrated provider with two engines, space and defense tech, serving national security customers with a mix of that long-term R&D and much faster, higher volume product sales.
Okay, let's get into the numbers. This is where the story gets really interesting, because you can see exactly how this transformation hit the books. The income statement, the balance sheet, the whole shebang. So, you open up the 10K, and bam! The first thing that jumps off the page is this staggering number, a net loss of over $226 million. And look, on the surface, that looks, well, it looks pretty alarming.
But headline numbers like that can be really, really misleading. So the most important question you can ask is this: what's actually driving this massive paper loss? Is the business falling apart, or is there something else going on under the hood?
And when you dig in, you find that a huge slice of that loss, we're talking over $130 million of it, came from things that were either one-time charges related to their big pivot, or they were non-cash accounting items. You can see it right here. Huge chunks from equity compensation tied to the acquisition, a big asset write-down on their European business, and the direct cost of the transactions. This stuff isn't about the day-to-day operations losing money.
And this number right here tells the other side of that story. So despite that giant loss on paper, the company's actual ability to pay its bills, its liquidity, was still really strong. They finished the year with almost $130 million in cash and available credit. It's that classic difference between a scary-looking net loss and the actual cash health of a company.
All right, let's talk about the heart of this whole transformation, the acquisition of a company called Edge Autonomy. This single deal created a whole new defense technology division for Redwire, basically overnight.
This table just lays out the new company structure perfectly. Look at the difference in the revenue models. You've got the legacy space segment, where almost all the money comes from long-term contracts. And now it's paired with this brand new defense tech segment, where 85% of the revenue is from selling actual products, much faster, higher velocity.
And the impact was instant. This acquisition became the main growth engine for the entire company. It brought in over $107 million in revenue in just the back half of the year. This is what was fueling that incredible top-line growth.
But a pivot this big and this fast is never clean, right? It comes with some serious growing pains. Redwire inherited some major internal control problems with the acquisition. And, maybe even more critically, the company had to report over $54 million in cost overruns, mostly from their legacy space projects. This really shines a light on how risky those long-term fixed-price contracts can be. Sometimes costs just get out of control.
So after this absolutely massive year of transformation, what's the road ahead actually look like? What can we expect for 2026?
Well, the outlook for the future starts from a very strong place. At the end of 2025, the company had a total contracted backlog of $411 million. Now, this isn't hopes and dreams. This is firm, signed orders for work they need to deliver.
And what's great is that Redwire's own filings give us a roadmap for future revenue. They say they expect to turn about 54% of that backlog into actual revenue over the next year. You do the math, and that gives you a baseline of roughly $178 million in revenue for 2026. And that's just from the contracts they already have in hand.
And this really brings us to the final, and I think most important question. Redwire has pulled off this incredibly bold strategic pivot. The orders are there, this new dual-engine structure is in place, but the key challenge, the thing to watch for in 2026, is all about execution. Can they get those cost overruns under control? Can they truly integrate these new businesses and turn this transformation into real, profitable scale?
This analysis is provided by HDIN Research. For more, visit www.hdinresearch.com.